Hello and welcome to this week's instalment of Nucleus Investment Insights. We have another special guest this week in Patrick Poke. Patrick is an editor at the popular Australian investment insight publication, Livewire Markets. From macroeconomics and market trends to stock-specific commentary and investment strategy, Livewire Markets provides a popular and well-respected platform for investment industry professionals to share their views and experiences in the public domain.
I also want to preface this interview with just a quick overview of where we want to take this. So it's a little bit different what we're running this week. This week, as Tim said, we've got Patrick on with the idea that Patrick's quite involved in the whole industry of investment insights. And what we really wanted to do is give you an idea of what else is out there. That it is relatively thin on the ground in Australia. So what we really wanted to look at is which fund managers and commenters out there in the market were actually really interesting, and what other websites and information sources there are. And so I think what you'll find is that Patrick's views on that, having been in that industry and just talking about how the industry has changed over the time, is quite insightful in terms of finding investment research and investment podcasts in Australia.
So join Nucleus World's Head of Investments, Damien Klassen, and myself, Tim Fuller, as we spend an hour with a fellow thought leader in investment media. I hope you enjoy. Today on the show, we are very fortunate to have editor of the acclaimed industry masthead, Livewire Markets, Patrick Poke. Welcome to Nucleus Investment Insights.
Thanks very much for having me on.
Lovely to have you. Okay, so just as a quick bit of background for our listeners, I guess, for Livewire, and also a little bit about yourself to get us going.
Yeah, well, I'll start with Livewire and then tell you a bit about myself after that. But Livewire was founded just over 6 years ago by James Marley and Tom Mackay. They'd worked together in the past, and they saw a bit of a gap in the market in Australia in financial media. There was a lot of fund managers and professional money managers out there that wrote and shared a lot of content on a weekly, quarterly basis. And a lot of it was not getting read by anybody. You know, they release it to their investors, some of which would read it, probably most of which who didn't. But all of this effort was going into writing all this content that wasn't going to be seen. So the idea, I guess, was to put it all in one place where people could find those ideas and, you know, really get some value out of them. Make it free for users, which is always nice. You know, people are always very hesitant to pay up, especially when it's online. Actually, if you'll allow me to digress a bit, I had a bit of a similar experience myself. I'm a keen amateur woodworker, and I was buying some equipment and some wood and a few different things for a little project. And the plan that I had for it, I didn't want to spend money on the plan. It was $5. I'd spent like $150 on wood and materials, and I was like, why are you being like this? It's $5. And it's because it's on the internet, not, you know, paying for content, I think, is really hard for a lot of people. So, I mean, yeah, that's where the idea came from. And it was certainly pretty tough at first, you know, getting that initial audience and getting the initial contributors. But once you reach a bit of, I guess, a critical size, it all starts to build and to snowball from there. I came into the business a couple of years later. My background includes superannuation, insurance, a little bit of retail banking, but mainly I came into the business because I love investing and I love writing. I used to write reviews of stocks in my spare time, just
for yourself.
Yeah, exactly, and for other people too if they wanted to read them.
Yeah, sure.
And James saw a couple of those and got in touch, and I guess it's all history from there.
All right, fantastic.
So in terms of the, I guess over that 6 year period, I guess what I'm interested in as a I guess sort of meta commentary on the research business is, we've really had this dying down of broker research as you know, people have left that industry and regulations have sort of clamped down on that, which meant that broker research used to be the sort of key place for this. At the same time, we've seen all the newspapers as well just wheel right back on in terms of all their of all the journalists, you know, at the AFR and you know, the Fairfax mastheads and those types of ones. And so I guess what I'm interested in is how much of the growth do you think is sort of associated with your competitors falling away and sort of there actually being a bigger need for a sort of carefully thought out research and commentary versus, I guess, growing into what you think was a market that was already there?
I think there's definitely an element of both there. It's hard to deny that the falling away of broker research has got to play some kind of role. That being said, broker research is generally a positive thing for us. People like reading broker research, particularly if you give them a big list of stocks. 10 stocks that we like this month is, people like reading that stuff.
It's a big article.
Yeah. Even if they don't go out and buy any of the stocks, they'll still read it consistently. So that being said, though, I do think there was a genuine gap there that was being filled. I think we do have a slightly different model to most of the we're not trying to, we're not particularly heavy on advertising. We try and keep it, obviously there's got to be some advertising, but we try and keep it minimal for people and give readers a really good experience. We try and focus on the reader, and I think that, I hope that shines through.
Yeah, okay. Yeah, sure.
And I guess that sort of leads into the sort of second part is that I think as a industry veteran of reading lots of research myself, I think the first thing most people who have been involved in the industry for a while is think about, okay, well, why has this person written what they've written? And so I think from when you hear a broker research, the first question is, right, are they trying to raise capital for this company? Is there something going on in the background? It's usually buy for a reason, because that's what they're doing. They're trying to raise capital for companies, and they're trying to sell it to other people, and that's sort of their business model. You read a fund manager research, and it's usually, look, I've already bought this stock, and I want you to buy it as well, or maybe I even want to sell it to you, as I need to get out, and so I need someone to take the other side of this transaction. And so that's sort of the first thought you always have is, as you're reading those, is, right, okay, why do you want me to? Why are you trying to convince me to buy this stock? And then you get sort of the companies part, where companies are obviously always trying to put a positive spin on their part, and then journalists who sit somewhere depending upon where they've been fed information. So I guess what I'm interested in is, I guess it's a long-winded question, but the idea is that as you are putting together these contents, I guess, where are you trying to see, where do you see the conflicts in terms of doing what you're doing in terms of pushing other people's, where do you see the line that you need to start stepping in and putting editorial into there to sort of draw out what's really going on?
I think as an investor and as a consumer of financial content, the first thing you need to do is accept that everybody is biased.
Yep.
Nobody who's out there writing financial content is going to come at it from an unbiased point of view. It's just about impossible. So I think that's it's a good point to start at. I think with all of the kind of research that you mentioned, I think there's value in it, particularly in the information that it provides. I think what you need to avoid is putting too much weight on the conclusions that they draw. So using the broker research as an example, I think with broker research, there's often, if you look on page 2, 3, 4, 5, 6, that's often where the best stuff is. Looking at the first page, and particularly up the top left corner where there's a buy recommendation and a target price, I don't think there's any value in those whatsoever. And I'm sure you guys are aware there's plenty of research that suggests there is actually not much value in those. That being said, there's, when you're a retail investor who maybe doesn't have the time to go out and meet with a company themselves, doesn't have time to do deep industry research yourself, then maybe you can actually get some value out of the information that they've provided to, back up and justify their points of view. With fund managers.
As a fund manager, I say I get lots of value for broker research, but as you said, the value usually is in that top left corner. It's
exactly.
Saying, I want to hear what your interpretation of what management's told you, and then sort of get into that whole part about, okay, are you overcooking it, or where do you sit on the whole spectrum of capital raising, not capital raising?
Yeah.
Do I think you're independent? What have you said before? How's it changed? All that type of things. Yeah.
I think it can be good to actually consider what biases the person who wrote whatever you've got has as well. Not just accepting that there are biases, but, as Charlie Munger always says, look at the incentives. The incentives is what drives people to action. So if, again, using the example of broker research, they're trying to raise capital. So, of course, their incentive is to be positive all the time. Fund managers are incentivized to talk about stocks that they're already in, and probably stocks, let's be honest, that have gone up a bit. Personally, I don't see or hear a lot of fund managers out there talking about stocks that, that have gone down 20, 30, 40% since they bought it. I will, and I'm in the greatest respect to these people, call out one fund manager, though, that does do that. And I think it's great to hear and see. Actually, two that I can think of. And we're going to discuss them a bit later, I think. But both Alan Gray and Forager Funds, they're probably the two fund managers I've seen who are most comfortable talking about mistakes and talking about things even if they don't go right for them.
Okay. And how does that play with the audience, do you think?
I think people appreciate the honesty.
Yeah.
Particularly, I know Forager's one that I've heard a lot of people talk about. Steve, if anything, maybe he spends a lot of time talking about his mistakes, and he even talks about the fact that other people call him out for spending so much time talking about his mistakes. Sorry, excuse me, I'm just coming off the back of a cold. But yeah, I think broadly as an audience, most people appreciate the honesty that comes with talking about your mistakes. And people don't like disingenuous people. One of the questions that I like to ask on the podcast from time to time is tell me about a mistake that you've made as an investor. And I find it really revealing what people talk about. You get some people who will talk about a genuine mistake, something that's really gone wrong. And then you get other people who might be like, maybe I should have bought Afterpay before it went up.
Oh, right. Yeah. I was going to say it's like a job interview mistake where you swing it around into a positive or something at the end.
Exactly.
Yeah, sure. Okay, very good. Just a quick one on that. So from an editorial perspective as well, do you find that you need to maintain a sense of balance in terms of, you're getting sort of sell side and buy side sort of coming in, no doubt stories coming in all the time. Do you find that at some point you need to sort of go, okay, I've filled my boots on broker side and I need to now, see what's available on the manager side or something like that?
Very much so. Look, our business is a bit more focused on the managers and the brokers these days, but that's partly because of what, we were discussing earlier about the decline in broker research. But yeah, we definitely try and offer people a bit of balance. And it goes beyond just looking at brokers versus fund managers. It also includes having a balance between Australian equities and global equities, between
bonds are big.
Yeah, exactly. Between asset allocation and stock picking, between small cap equities and large cap equities. We want to try and serve people up a balanced diet, if you'll allow the analogy. I always say, there's things like a list of stocks might be like having a candy bar. Everybody enjoys having a candy bar. Everybody enjoys reading a list of stocks, but you probably haven't really learned anything from reading 8 hot stocks that are going to go up. But you had fun, right?
Yeah.
On the other hand, some of the more in-depth educational or analytical type stuff sometimes isn't as easy to read or isn't as exciting. But often that's where you find the best insights.
Yep.
So yeah, on all fronts, we try and offer people diversity and balance in what they're listening to and reading.
Yeah. Okay. And so talking global research, obviously there's versus 10, 15 years ago, it's now much, much easier to trade international stocks, and you get fund managers like ourselves, as a quick plug, to who are investing international stocks for Aussie investors. And economies are a lot more synced up now. So we've seen interest rates, the interest rate cycle across basically all the developed countries are pretty much in sync. So how much, I guess, have you seen in terms of your business, and how much you expect to see? Are you expecting that as a continue? You're going to need more and more international insight and less Australian, or is this something you think that the local side of it will always be of more interest to people in Australia?
I think there's definitely been a significant increase in the interest in global equities or global investing generally. I'd say probably in the last 2 years, maybe 3 years. I think it's been driven, there's a lot of forces driving that. I think, if you're going back, if we go back 5 years or so ago, most investors, I don't think, would have even been conscious of what is now a very well-known statistic that 2% of global equities are in Australia, 98% are elsewhere. Yet, I think Australian investors still probably have in the range of 30 to 40% of their portfolio on average in
local stocks.
Yeah. But of course, franking credits are always going to throw a spanner in that. And I think people have a fundamental attraction to what is familiar and close to home for them. A lot of people like investing in businesses that they can see when they go down the street.
Yep.
So I think there will always be a strong interest in the Australian side of things, but definitely a growing, and I expect it to continue to grow, especially with the biggest businesses in the world are global consumer businesses. So people might not have been familiar with PetroChina 10 years ago, but everybody knows Google and Amazon and Microsoft.
Yeah, and I was just going to say that, I guess the growth of the perspective and the time that's been spent by these overseas companies coming into the Australian just everyday life, like your Facebooks and your Googles and now Amazon somewhat. We're sitting in a WeWork at the moment, but that might not be around for in the next 6 months. So that obviously then means that, for yourself as a content creator, you need to hit those marks now. You need to be, reflecting people's thoughts on those stocks because, they're more and more coming into the psyche of the average Australian, I'd imagine.
Yeah, I would agree with that. It's also interesting seeing things coming the other way as well, is the global managers coming into Australia.
Right.
I think probably the most high-profile one recently has been Glaucus, or Bonitas as they're known as now, who have issued a number of very public short sale reports on some relatively well-known Australian companies. And I think it's an interesting dynamic that it seems to me that global managers are starting to pay a little bit more attention to Australia at the same time that Australians and Australian managers are paying more attention overseas. And I think it probably comes back to that same issue of globalization that you were talking about before.
Yeah, but I guess in a way there's sort of this part where most of the time you pick up the local newspapers, you still don't see, Microsoft did whatever, or Apple, or actually Apple and Google, you maybe might see it, but beyond those sort of top couple, it fades away pretty quickly. So Johnson & Johnson, for example, the likelihood of reading about that in the Fin anywhere near the front pages or the Age or the Sydney Morning Herald is pretty low. I guess, is that an area where you see you might have an advantage, or is this one, or you're looking to grow it, or is it more of a, because it's hard to know where the push-pull comes from. You only get more eyeballs wanting to see this stuff when they see it in their local newspapers, or is it more that, look, if they do want to see that stuff, they're going to go to the Wall Street Journal, or they're going to go to the Financial Times, and so let's sort of play in our space. And
we kind of let the audience tell us what they're interested in as much as we can. Obviously, being a digital publication, we've got much better idea what people are reading than you would have in an old school newspaper. We see the headlines and the topics that people engage with.
Yep. And
although we try not to just serve them up, that we don't just want to be.
Well, that's right. You can't
giving them lists of stocks.
You don't want to be BuzzFeed.
No, exactly what I'm trying to say. But we try to give people what they're interested in. So if people are interested in Apple and Google and Facebook, then we'll serve up more of them. In my experience, there's a limited interest in it. People do want to see a bit of. People do want to see a bit of it, but they generally don't. It's not going to be the meat and potatoes of their investing media diet.
Yep. Yeah, no, that's a great point. And I guess going back to the whole focus on overseas, and even now we've got Australian markets at all-time highs. overseas US markets at all-time highs as well. So it leads me to the next question of the best of the stock market bulls. So I guess, who do you think, I guess, in your panel of recent...
and actually, so frame this another way. We've been relatively bearish, I guess, in terms of what we've been looking at and looking at the valuation. So where markets are is one thing, but making sure, if the valuations start getting stretched and the earnings isn't coming through, that's where we start to get concerned. And we're sort of... we're always looking for people who challenge our views, and I guess it does seem to me that there's more and more bears certainly coming out at the moment, but there's always two sides to a story, and there are reasons for markets to keep going up. And I guess of the people you look at, who's got the best reason in terms of that sits with you in terms of and the arguments they're using to why.
Yeah, I certainly identify with that. My own personal inclination is towards one of bearishness, but then I'm consciously aware of the fact that most bears are wrong most of the time.
Yep.
And so I have to constantly check myself, and sometimes I don't always act the way that I feel, if that makes sense.
Yep.
But to answer your question, it's funny that you open the question with discussing indices at all-time high, because the first person that I'm going to mention, he mentions that as being one of the reasons to be bullish. And so that's Ben Griffiths from Ellie Griffiths Group.
Yep.
So he presented at Livewire recently, and he's written a couple of articles recently that were quite bullish. So one of his points is that indices are at all-time highs and credit markets are benign. And when you've got those two ingredients together, generally markets go up. Because as you know, most of the time, equity markets are, and most of the time they're at all-time highs too.
Yeah.
When you're in a bull market, particularly when you've been in one for a long time, you're going to be setting new all-time highs all the time. He also quotes the Goldman Sachs FCI, the Financial Conditions Index, which he said has been loosening for most of the year. I don't actually have access to that index myself, but I would imagine it was probably coming from a place of extreme tightness at the start of the year, with the Fed was raising and expectations were that the Fed would continue raising. I believe equity prices are also an input to that index, I think. So I'm guessing the fall in equity prices would have, at the end of last year, would have affected that too. He also makes a point which obviously people are moving up the risk scale. There is no alternative. You've got to invest your money somewhere. People are getting 0 to 1% on cash. They're getting 1% usually on bonds if you're lucky.
Getting 1% on cash.
There's still high interest savings. Well, I feel like we should get rid of the name high interest savings account. It just seems like a misnomer these days.
And not zero.
Yeah. The ACCC will start pinging people on it fairly soon.
I reckon. Equities, you're getting 4% in Australia, plus they're fully franked dividends in a lot of cases. So people are moving up the risk curve. I find that an interesting point, though, because I think you could equally use that as a point to justify a bear case. And in fact, I have heard it being used to justify bear cases a lot. So, but, at the end of the day, people are still getting more money. There's always going to be money flowing into assets somewhere, and it's got to go somewhere. And his final point was that investors are broadly very bearish, which I think is a fair point.
I think that's a very good point.
And usually investors are very bullish before a crash.
Yeah.
So and I actually think that's the strongest point that he makes personally.
Yeah, I agree. I mean, the thing that worries me most is that I'd love to see a whole bunch of other people saying, "This is fantastic. Look how good the markets are. This is the last chance to jump in." And then whereas I think we're the same. The fact that so many people come out and say it, you sort of go, well, how often does the market crash when everyone says, hey, look out, the market's about to crash?
Yeah, they're all prepared. The shoe shiner is saying put your money in under the bed rather than put it in the market. It's probably not a crash. It's a reverse dichotomy.
Phil King from Regal Funds Management made the point, again at Livewire Live, that there's the old story of when your taxi driver tells you it starts giving you stock picks, it's time to get out of the market. Well, he said he was in an Uber a few weeks ago and his Uber driver told him, that he'd recently sold all his shares because he thought the market was overvalued.
Well, there you go. All right, next point. We've got your one, Damien.
RBA, yeah. So same type of thoughts in terms of who do you think's got the most interesting sort of views on interest rates at the moment?
Well, look, I'll be completely honest with you. Interest rates, in terms of particularly cash rates, is not something that and particularly forecasting them, is not something I follow super closely. As an investor, I don't feel like I get a huge amount of value out of whether I can accurately predict when and in which direction and by how much the next RBA move or the next Fed move is going to be. There's also, from a content person's perspective, there's not a huge amount of interest in the topic on a regular basis, and the mainstream newspapers usually cover it really well. You go into the AFR and it's not hard to find, an article with 5 different economists all giving their view.
And 3 of them from the same bank.
Yeah. And for me, I always ask the question, what value is there in this for me as an investor? Or if I'm got my editor hat on, it's what value is there for the audience to get out of this? And I find predicting the future direction of rates is not something that get a massive amount of value out of. That being said, there is one bond fund manager that I would call out as having generally quite interesting views on interest rates, if you'll excuse the pun, and that's Charlie Jamieson from Jamieson Coote Bonds. He's always very insightful. He's a really good presenter and he tells great stories, but he's also pretty good at being right, which is is important too. He's a really experienced investor, and I think I find I always walk away after having listened to him or even having interviewed him. I feel like I've learned something new. By way of an example, last time I interviewed him, I asked him the question, there's $14 trillion, I think it's now 17, but $14 trillion of negative yielding bonds around the world. This is crazy, right? Not in those exact words, but that was roughly the question. And he explained to me that for a foreign currency investor, so if you're an Australian investor and you're buying, say, a German Bund, you'll generally enter into a currency swap arrangement in order to do so, which also involves swapping the interest rates. And as a result, because it's a negative interest rate on the on cash in the ECB, you're actually getting paid that, but you're also getting paid the cash rate on the Australian because that's positive. And the combination of the dual yield you get off the interest rate swap and the currency swap actually means that you get a positive yield of some of these bonds that look like they do have negative nominal yields. But for a foreign currency investor who invests in a currency swap, they can actually have a positive yield. I thought that was just really interesting. It wasn't something I'd ever considered before. For the average investor, it's who thinks about currency swaps.
So on that point, Damien, we're going to see any negative paying bunds in the Nucleus wealth portfolios?
No, I don't think that's something we're planning on. I mean, my take on international investment, and I take your point for professional managers. It is something you can invest in. I think for some of the smaller accounts, and we run separately managed accounts where we put everyone owns the actual securities, and so it is a lot harder to do swaps and all those types of things. But the other thing you find when you start buying international bonds is you go, well, you end up with roughly the same yield as if you had bought an Australian bond, because that's the way the swap. Otherwise, there's arbitrage. So that's what the swaps all work. And so what we find is saying, well, just a minute. All I've done is I could have just bought the Australian one, but what I've done is a complicated swap, and I've picked up a few extra basis points and got a German one. But if something goes wrong, Germany's probably a bad example, maybe a Spanish bond, or if something goes wrong and they default, when countries default, they don't default on their local people first. That's the last ones, because those people vote. Whereas you try and, Argentina's a great example, you default on your foreign borrower. So I'm worried with those when you start doing that. You might do a complicated swap, you pick up a few extra points, but you've just picked up all this extra risk you didn't have, and you could have just bought the Aussie ones. And
So what's your take on the Argentinian 100-year bond then? Is that going to be one that's going to be appearing in
not a buy, no, not a buyer of that one. But the other point, I guess, I like on the RBA stuff, I find anyway, is that there is a huge following in Australia among all those people, as you said, who write for all these Aussie banks, and the Aussie banks tend to have 3 or 4 economists. I wasn't joking when I said, 3 from the same one. They're all with nuanced views about it. So you're like, oh, we're wheeling out to one guy. Well, let's wheel out this view, and we wheel out to somebody else. Let's wheel out a different view and make a trade. But there's so much focus on the what are they going to do next week? What are they going to do next week? As opposed to, well, what should they be doing over the next 18 months? And if they keep doing what they're doing at the moment, what's that going to do to the economy? Forget whether they cut next week or whether they wait a month or 2 months or whatever it is. It's not in the end, unless you're trading bonds and very highly leveraged at the very near end bonds, you're not going to make any money from that. Yeah. So, I'm certainly with you in terms of we get more than enough interest rate commentary in Australia in our newspapers to
and it's so directly linked to house prices, which is everyone's favourite topic, that it's a go-to for the mainstay media, isn't it?
Yeah, and I wonder whether that's almost a reason why you get a lot more focus in Australia than what you do overseas on it, because of that same interest from the average person in the street, because you're like, yes, if they cut rates, I get
an extra $50 a month
straight away.
I've got to be honest. If I was in Denmark, I'd be pretty interested in the rates that they had there on their home. Is it Denmark that had the issue?
The negative rates, yeah. Having said that, I think the trick there was there are fees on the account, and
of course,
so you might think you're getting negative rates, but basically you're getting negative rates which offset the fees, and you end up basically,
Hey, still 0% on a mortgage ain't bad.
Exactly. yeah, that's right. Yeah.
Yes. Very good. Okay, and so we might just roll into a reflection on your most interesting interviewee over the years. Obviously, you've run into some fairly interesting characters in Australian finance, so it'd be great to hear your thoughts there.
Look, I'm going to make it difficult for you. I can't give you one. I'm sorry.
No. It doesn't need to be one. Are there any ones in particular that you find are always entertaining? And I guess there's a difference between somebody who's entertaining in terms of, hey, these guys got some really interesting views. Might be wrong, as you said, that some of those, there's people like you spoke about Charlie Jamieson as being not only having interesting views, but often being right, which is a good thing. But there are people out there I find who are consistently wrong, but consistently come up with actually quite interesting things. And every now and again, they score one fantastically well. And it is worth reading those people just for the fact that they've got a different view to everyone else.
Yeah, look, the interviews I find the most interesting personally are the ones where I think there's been some really valuable learning opportunities. So I'm less interested in, what their stock picks are, and more interested in what they told me about how they came to that stock pick, if that makes sense.
Yep.
And also, I really enjoy speaking to people that don't speak to the media very often.
Yep.
So.
Oh yeah, that's right. That sounds awfully like, yes, I like meeting younger people of my preferred sex because they're not that experienced and I can take advantage of them. sounds like
Sorry, I didn't mean it in that way at all. Look, there's a lot of people who are out there in the media a lot, and we hear a lot of their views, but there's also some incredibly talented investors that the average person who doesn't work in this industry has probably never heard of. Probably one of my favorite examples on that point is Peter Cooper. Before I started working in this industry, I actually didn't know who Peter Cooper was. For the sake of the people listening, he runs a company called Cooper Investors. They've got about $12 or $13 billion of funds under management. It's a little boutique out of Melbourne. They've got some really, really talented fund managers, and Peter himself is one of the most experienced investors in the country, honestly. And he doesn't do a lot of interviews, especially in-depth interviews. So I was really lucky to get to sit down with him for the best part of an hour and just pick his brain as to what he thinks, how he thinks about the world and how he thinks about investing. If I had to pick a single thing that I thought was most interesting that came out of that, he made the point that a large part of the alpha he's generated over the past 20 years has been because of falling interest rates and his understanding of the opportunities that provided. He made a lot of money off things like banks and insurance companies that were on the way down, exposed to falling rates. I think it's safe to say, I hope it's safe to say, that that theme has probably played out at this point. I don't think, look, rates might go a little bit lower. I don't think they're going to go another 10% lower. I feel pretty confident in saying that, but I'm probably going to look like an idiot in 10 years' time now. But his point was that his big idea for the next 20 years, the big kind of structural change that is happening that everybody's aware of, but which you can still make money off nonetheless, is demographic changes and the aging population. And, there's so many different ways that you can benefit from an aging population, whether it be, in obvious ones like investing in aged care. There's a lot less obvious ones as well. Maybe you want to be short private health insurers. I don't know. There's probably some unusual ones out there that none of us have thought of yet. But that you can't avoid the fact that populations are aging, not just from people are living longer at the end, but also you've got the weight of people coming into that later stage of life, the baby boomers,
and they're often the richest sector of the section of the age bracket as well. So.
Yeah, it's a good point.
Yep.
And there's a lot of services and things that they're going to need, and chances are it's probably not baked into every stock price around the world. So if you look for those opportunities, it could be a very good hunting ground, I think.
Okay, fantastic. And on the flip side...
any others sort of in the interviewing?
So another one I really enjoyed was earlier this year was Robert Milner from Washington H. Soul Pattinson. So Soul Pattinson's I think it's the oldest listed company in Australia. They've been around for well over 100 years. I'm sure everybody knows them for their chain of pharmacists, but it's actually a relatively small part of their business. They own, they've got a huge investment portfolio that includes things like TPG. They were an early investor in TPG. They own coal assets. They own
Brickworks.
Yes, of course, Brickworks. And Brickworks also owns a bit of them.
That's right.
And they've also, they've got a whole portfolio of earlier stage investments as well, and they own property. It's a very interesting portfolio that doesn't look a lot like anybody else's portfolio out there that I've seen. And he's got a great track record. I mean, the company is every year for the past 100 years, I think they've paid a dividend. I think that's right. I'm pretty sure that's right. And they've increased it every year for the past 20 years.
Wow. Yeah.
Dividend growth is a wonderful thing. And if you can come up with a formula that allows you to keep growing dividends year on year on year, then
make a lot of friends.
Yeah.
Okay, very good. So flipping it around, the King Contrarian. So who have you got from an opposition sort of viewpoint? So have you got any of your favourite contrarians that you like to call in on to balance out a big bull case?
Yeah, look, I don't know if they're contrarians in the sense of them being super bearish, but they are contrarians in, fundamentally at heart. They like to buy things that everybody else hates, and they like to avoid things that people like.
Yep.
So there's a couple of fund managers that I think do a really great job, and I did actually mention them earlier. One is Alan Gray. So they were founded in South Africa and came to Australia, I think, 10 or 15 years or so ago. They've got a really talented team, but a lot of people talk about being value investors and about being contrarian. These guys really, really are. And it feels like it's just fundamentally part of their DNA. Like I don't want to say almost to a fault, because I don't, they have to be contrarian. Now, I mean, that can be a danger sometimes, I think. But I think they also recognize that. But, they've been invested in AMP for quite some time, and they were happy being publicly long AMP as everything was going well. Now, that hasn't played out well for them yet, but they've got plenty of older examples of similar situations, which when you're patient, they do play out. They were in Telstra when that was right down in the dumps. I think that's recovered quite a bit now. So at that large cap end of the market, they have really high conviction and they do deep research. They're not always going to get it right. I think, being a contrarian investor and investing in, what a lot of the time...
extreme value.
Falling price.
Yeah. You're going to get some wrong, but you can also make some very large returns on the ones that you do get right. So if you can get, 6 out of 10 right, or maybe you don't even need to get 6 out of 10 right. If you can make 200% on the ones that you get right and only lose 30 or 40% on the ones you get wrong, then even a 50% strike rate looks pretty good.
Yep.
The other one, so that's, I guess, at the large cap end of the market. More at the small cap end of the market, forager funds and Steve Johnson in particular, they really like buying some some stuff that even when I look at it, I'm like, oh, wow, that's nasty looking. But it's worked well for them over the years. They've had a bit of, it's been a bit of a struggle for them the last 12 or 18 months, but I don't think they're unique in that regards. I think there's a lot of really talented fund managers out there that have had a tough time lately. But I'm kind of the view that underperformance is a necessary precondition for outperformance.
Okay.
If you're not prepared to
stick your neck out.
If you're not prepared to underperform from time to time, then you're not going to outperform.
Yep.
If you're not prepared to underperform from time to time, go buy an index. Yeah.
I was going to say, if you're going to index hug and not stick your neck out, then how long are you going to last?
Yeah. So they're probably the two that I would call out as being the contrarians that I really like to hear from.
Okay, very good.
Yeah. One of the things I note, and this is not just you guys, this is sort of a bit of a global across all media, is you don't really hear much from the superannuation funds. So you hear from the managers below, but and I guess, or the asset consultants. So you sort of have this part where so much of Australian money is invested through super funds, and the people who run the funds, you very, very rarely hear from. And when you do hear from them, it tends to be, this guy was the best over this period, and he says, oh yeah, let me tell you what I did last year. And then you're like, well, that's great, but what are you doing next year? It's like, well, the guy didn't ask because, or it wasn't offered. Do you hear much from them, or what do you think? How do you put down the silence you hear from that area?
It seems to be very much their own choice. I think that people do want to hear from them, but they don't seem to want to talk to the media very much.
And particularly now where it sounds like they're internalising so much more of their funds under management.
Which is more important.
Yeah.
So, I'd say if, I guess one of the things we find we're picking up a lot of super clients from industry funds because we do the full transparency and we'll tell you exactly what's going on and all that type of stuff. And I just find it's interesting that, as I said, they're internalising more and making less out there, but at the same time, not offering anything to...
Yeah, look, I don't have a good explanation for you as to why they don't want to talk to the media. It seems to me to make sense to want to talk to the media. I mean, brand awareness and is going to help them with getting fund flows. It's basically free marketing for them.
Yeah.
Being out there in the media, and it also helps their investors better understand their strategies. So, from my perspective, obviously I'm biased, but I think it would make sense, particularly for these big ones that are starting to move their investment management in-house to be a bit more active in the media and talk a bit more, not just about what they have done, but what they're positioned for in the future. So if the Chief Investment Officer of Australian Super's listening, feel free to give me a call.
I was going to say, we'll throw out the gauntlet to Mr. Silk if you're listening in to give Patrick a call. I'm sure he'd love to take that call. So
I do see Ian Silk out on the street sometimes. He's a very difficult person to miss. He's very distinctive.
Isn't he? Yeah. Just needs a 10-gallon hat, I reckon. But anyway, that's a whopping mustache. So we might just finish up too. Just we'll run quickly over a must-read list, if you will. Obviously, you're a very well-read guy. So what would you like to share with our listeners?
And I guess, can I give you a little bit more guidance on that as well? So I'm interested in hearing what your Yeah, so there's obviously a lot of Australian people who are on your list, and so you want to give us those ones. But I guess globally, if there's ones where you're saying, well, okay, when I wake up in the morning, I've got my RSS feed or my newspapers, and these are the 4 or 5 places I find I have to get my feed from.
I'll be honest, I actually prepared for this thinking that you wanted books.
Oh, okay. All right.
I've prepared books, but that being said, I could probably come up with a couple of things that are worth reading on the internet. So
Yes.
one I would say would be Barry Ritholtz.
Yep.
He's got a great podcast and he's got a great website. I'm blank.
Ritholtz Wealth Management, the big picture.
Yeah. Thank you. The big picture. That's what I was trying to remember. I've always enjoyed reading his content. It's not technically business content, but I would also say Farnham Street is a great one that's worth reading. He talks a lot about how to learn, how to absorb information. It's really, really different. He is a keen investor. Farnham Street is a reference to Warren Buffett because that's where the Berkshire offices are on Farnham Street. But I guess he focuses more on the psychological side of things.
Yep.
That's definitely worth reading.
And that sounds similar to Barry, isn't it? Like Barry spends a lot of time talking about how investors can make mistakes and how your brain works against you. Your natural instinct is often wrong for a lot of these things. So so it's obviously a bit of a bent you have for
it is. And the first book that I'm going to mention is very much along that same line as well, which is The Most Important Thing by Howard Marks.
Yep.
I'd say that along with One Up on Wall Street are probably the two books that have influenced me most as an investor. The Most Important Thing talks a lot about, where does alpha come from? How should you think as an investor? And I feel like that is, for the average person who wants to invest, you can't get an informational advantage. You are not going to be able to take a headline and act on it quicker than an algorithm or a professional trader is. Yeah. So where can you get an advantage? And I think that the best place for the average person to get an advantage is a psychological advantage. Fund managers, for example, usually have to report monthly or quarterly figures, which means that they have career risk to worry about, which is why they tend to hug indexes. If you're aware of that bias, then maybe you don't fall victim to some of the same traps. Maybe you can take a longer term perspective than a fund manager might be able to, because you don't have investors knocking on your door going, why is this stock going down?
And it's a J. I look at these all the time. There's the J-shaped companies where you're like, look, I can see where there's going to be bad news for the next 6, 9, 12 months. But then after that, I can see where all these things are going to clear, and all of a sudden you're the Stephen Bradbury, and everyone's going to fall over in front of you, and off you scoot through the middle. But right now you're at the back of the pack, and it's a question about saying, okay, when do you try and time it? Do you try and get to the bottom, or do you buy it now and then have to excuse it for the next 18 months in your portfolio? And investors tend not to be that forgiving of anything that goes down, and so I can see where. Absolutely for an individual investor. The only problem with that, obviously, is when you pick those because you're like, I think I'm going to lose money for 18 months or maybe, and then it's going to come good, and the ones that don't come good, and you just
follow down.
You've wasted 18 months owning something that's only going to go down even further.
It's a tough one, but the problem with waiting until things get better is that the opportunities usually pass by then.
Absolutely.
So unless you're willing to take that risk, and you've just got to have conviction. I mean, we were talking a lot before about reading other people's research, and that's good, but no matter how much other people's research you read, you've got to do your own.
Yep.
And a fund manager might tell you in a story on Livewire that they think this stock is a great buy. They're not going to tell you when it's time to sell it.
Yeah, that's right. Yeah.
So you've got to understand the company well enough and understand the thesis well enough to know when it's broken. We've asked this question on Livewire so many times of, how do you know when to sell a stock? And almost without fail, the answer is when your thesis is broken.
Yeah, okay.
But if you're relying on somebody else's thesis and you don't properly understand that thesis, how are you going to know when it's broken?
Yep.
Yeah. And I think most of the research as well says most fund managers are very good at buying stocks, but where they lose out is selling stocks. And that's fund managers who do this for a living. So then you're going to say, okay, now you've got to go to an amateur who's doing it at home. Yeah, the same type of thing. Yeah,
it's tough.
That's where our plug again for us is what we tend to do is use the quant for that process, is to say, well, because we run a sort of quality value screen, and I find that the most important thing for me is often you might go, oh, look, here's an average quality stock, but I want to buy it because it's really, really, really cheap. And then so you buy it, next thing you know, the stock's doubled. And you start going, hey, maybe it is an average quality. It's just doubled, Maybe it's really good quality. I just didn't, And that's where people get stuck on where at least the quant goes, no, buddy. Look, the numbers haven't changed. This hasn't changed, or something's got only slightly better. It's still only average quality. Time to surf it type thing, as opposed to if you stick too much with your own gut and your own feeling, you love those stocks. Yeah. Whereas I've got a lot more sympathy for a stock that's very high quality. And you say, yeah, okay, I bought that and it's doubled. Okay, but it's still really high quality. Now it's got a lot more scope to run, and all that type of thing, is if it's still getting good returns on investment.
Yeah, I think I take somewhat of a similar approach myself, in that I let my portfolio sizes tell me when it's time to sell something.
Okay.
If I start seeing something that's 7, 8, 9, 10% of my portfolio, I'm going, all right, maybe I should take some money off the table here. Yeah. I'll just finish my book list.
Yeah, sure.
So I did briefly mention One Up on Wall Street. That is definitely worth a read. Peter Lynch is absolutely one of the best fund managers that has ever been in the business. He achieved, I think it's 29% per annum over 19 years, which is just outstanding. I mean, 30% is just crazy. And I think it's a really useful way of thinking about investing for retail investors. He talks, it's very much a product of its time. It's a book that was written in the early 90s, and you can tell that when you're reading it.
Yep.
But I think there's some really valuable information in there. And one last one I'll mention. I wanted to mention an Australian author, and I've had him on my show twice. Roger Montgomery wrote a book called Valuable, and I think it's a really practical book that talks about Australian examples. So I think for people who want to, we were talking earlier about how people always identify with things that are close to home.
Yep.
That he talks about stocks that you're going to know. He talks about JB Hi-Fi and ABC Learning, and he gives practical examples. And it's nice and straightforward, easy to understand, and it gives you I think, one of the things that is really good out of it is that it gives you a valuation framework that is, I think, better than using price to earnings ratios, but way, way, way more practical and easier to do than a discounted cash flow.
Yep. Okay. All right. Very good. And so, for the handful of listeners that haven't heard of Livewire, how do our followers get in touch with you and follow your work, Patrick?
Livewiremarkets.com. If you go on there, you'll find all my content on there, and from hundreds of other authors. You can also find my podcast, The Rules of Investing. It's on Apple Podcasts. Sorry, I almost called it iTunes. Apple Podcasts. It's on Google Podcasts. It's on Spotify, and it's on Stitcher. And we're also on YouTube. So Livewire Markets on YouTube. So yeah.
Fantastic. All right. And I often call it iTunes anyway, mate, so don't worry about it. I'm not an Apple user, so to me it's always going to be iTunes. But anyway, thanks very much for your time. It was great spending an hour with you today, and look forward to getting you on board again soon.
Thanks for having me on.
Well, that's it for now, and thanks for watching. If you like what you heard today and you'd like to hear more, head over to nucleuswealth.com/subscribe. Give us your email address, and in return we'll send you a weekly email with new webinar topics, links for our podcasts, and other news from Nucleus Wealth. I certainly hope you've got something out of today, as I have, and we'll look forward to catching you at the next one. Cheers. Hello and welcome to yet another instalment of our Nucleus Wealth Insight series. Just a quick reminder that the following presentation is general information only and does not take into account your personal circumstances. Whilst Nucleus Wealth aims to present informing and sometimes entertaining content, please consult your investment professional, financial advisor, or better yet, speak to us before making any decisions based on any of the themes discussed in today's presentation.